Tax deductions versus tax credit. A while back, there was a viral video going around of a father teaching his 3-year-old daughter the meaning of taxes. They are each holding ice cream cones, and the dad says, "Before you eat it, I need to take taxes." He then proceeds to take a big bite. Social Security and Medicare, he declares, and he takes a smaller bite. The kid is now tearing up. "One more bite. This is a small one. This is city taxes," he says as he takes a final nibble. "Now enjoy," proclaims the dad. The kid is mortified. If you're trying to find ways to save money or reduce taxes, you must consider tax minimization. In fact, dollar for dollar, managing your tax liability might provide a better return on investment than simply chasing investment returns. When we talk about taxes, there are many nuances and details that are hard to decipher for many of us. The truth is, like many things in finances, taxes can be quite simple. It's people who make it complicated. One source of common confusion is the difference between a tax deduction and a tax credit. A deduction is income that you can deduct from your adjustable gross income. Deductions reduce your taxable income. Think of a tax deduction like money you've earned and spent that the government says, "Okay, we like what you've done, so we're not going to tax you on that money." Examples of tax deductions include saving for retirement, qualified child care expenses, medical expenses above a certain threshold, and tax deductions are great. But tax credits, on the other hand, those are spectacular. Credits apply to your taxes due, and they're like a dollar for dollar rebate. For example, if you owe $10,000 and you're eligible for a $500 credit, then your taxes due will only be $9,500. Now, tax credits come in two flavors, refundable and non-refundable. Refundable credits means that if, after applying all applicable tax credits to your tax bill, the amount of taxes that you owe is a negative number, the IRS will kindly refund you the excess amount or credits paid to the extent of the allowable refundable credits. Now, non-refundable credits, on the other hand, will simply reduce your tax bill. The child tax credit is an example of a refundable tax credit, while the solar investment tax credit is a non-refundable credit. Getting back to tax deductions, which are more common than tax credits, it's important to know that deductions can go a long way to reducing your tax bill. Here are some common deductions. You have the standard deduction. Individuals and couples often take the standard deduction when their itemized deductions do not add up to a higher number. In fact, it's estimated that 90% of filers choose the standard deduction. Those more likely to itemize are filers that have high charitable contributions and medical expenses. Another credit is the retirement savings deduction and savers tax credit. Contributions to a regular 401k plan and a traditional IRA and other pre-tax retirement accounts may be deductible. Moreover, you might be eligible for an additional tax credit if your income is below an annual limit. There is also an HSA deduction or a health savings account. Contributions to your health savings account are tax deductible. 529 deductions. Saving for college offers a tax deduction too. Qualified child and dependent care expenses. Young parents paying for childcare can qualify for a tax deduction, such is also the case when you incur costs associated with the care of elders or renovating your home for a disabled person. Qualified business income, or QBI deduction. Small business owners with income below an annual limit can take a valuable QBI deduction. Several years ago, Congress doubled the standard deduction amount and greatly reduced the mortgage interest deduction. Those changes effectively eliminated the need for itemized deductions for many taxpayers. That's why so many Americans simply take the standard deduction these days. Getting your taxes done right and reducing the amount you owe is an important task each year. In retirement, we lose many of the credits and deductions we had in our working years, which can increase our effective tax rate. As retirees, we need to treat taxes the same way we treat market losses, as a scourge to be avoided. In retirement, every penny counts, especially when the market is down or it's volatile and the future is uncertain. For more information about how to avoid unnecessary taxation, check out Chapter 6 in my book, Living with Financial Anxiety, as well as my guide, How to Pay Zero Taxes in Retirement. I hope this helps, and if you have any questions, just put them in the comments or shoot me an email. I'm more than happy to help you out.